These risk management committees, they also implement the risk management policies and procedures that comply with regulatory requirements and best practices, identifying and assessing those risks, then monitoring and reporting maybe on the improvement of what they have implemented to outcome that risk. Then the committee is usually composed of executive and board members with expertise in risk management, finance, and other relevant areas. Then we have the nomination committee. Its function is to decide on new appointments to the board and other senior
This can be
positions.
done. This can be
Other senior positions in
within
the company.
company.
This can be done within company composed of executives and non-executive directors. This committee is also responsible for ensuring that succession plans are in place for the board and the executive level below it. Then they can also identify and access the skills, experience, and qualifications required for the board of members, develop a process of identifying and developing those particular skills and experiences in the members they will appoint. Mm, I I can stop there. Then my colleague can come in to talk about the composition of these mandatory committees in the different organizations and places of work.
Good morning, guys. So I'm going to discuss the composition of a mandatory committee. The mandatory committee comprises of at least 3 directors. The executive director, who is employed usually by the corporation. The executive director also has a significant business relationship with the corporate management. Then for the non-executive director, this director is not involved in any day-to-day business management of the company. The non-executive director also does not have management responsibilities. Then as for the independent director, an independent director is also known as an outside director. He or she has no direct or indirect material relationship with the company other than the membership of the board. The independent director also brings a unique and unbiased perspective towards the corporation. Yeah, so that's it for the composition of the mandatory committee. I'll let my colleague handle the rest.
Good morning, everyone. This is Esther. I'm presenting the non-mandatory committees. The definition is these are committees that are not among the main committees due to the uniqueness of the companies and regional markets. Another definition that I have here is non-mandatory committees are committees that are formed voluntarily by an organization or group or individuals address specific issues or projects. To help you understand more of the non-mandatory committees, these are committees that are not required by law or regulation, but are established to help achieve specific goals or objectives. They are usually made up of volunteers who have expertise or experience in areas of focus for the committees. For example, like event planning committees, fundraising, ethics committees, program committees, and the mentioned here. You can go to the next slide. These are the types of non-mandatory committees and their roles. One, we have employee social committees. These are committees. These committees are often established in workplaces to plan social events and activities for employees, such as holidays, parties, volunteer events. Mainly, these committees are meant to help or improve the employees' well-being or make them comfortable, like feel comfortable in organizations. The next committee, the diversity and inclusion committees. These committees are formed to promote diversity and inclusion in the workplace or community. They may develop initiatives and programs to increase diversity, address issues related to discrimination, and foster a welcoming environment. These committees mainly focus on promoting diversity, equity, and inclusion within a workplace. Therefore, these committees create a culture within an organization where employees feel valued, respected, and included. Another committee is the community service committees. These committees are organized to plan and coordinate community service events and volunteer opportunities such as fundraising events and environmental cleanup. Some okay, these committees, they are groups within an organization that are responsible for planning and organizing volunteer activities and community outreach initiatives. The goal of these committees is to give back to the community and make a positive impact. For example, activities concerning the environment like recycling programs, energy conservation campaigns, and environmental education initiatives. Uh, I beg to stop here and allow my colleagues to continue. Angel.
Let me continue from where my colleague has ended. The next we have curriculum development committees. These committees are formed in educational institutions to review and revise curriculum materials, develop new courses or programs, and ensure that institutional materials meet academic standards. Then another one, we have research committees. These committees are responsible for promoting and supporting research activities in the company. It provides assurance to the board that the academic policy assures the quality of research. Then another one is risk management committee. Its main responsibility is to monitor and appraise the risk policy and associated practices of the company. It is also responsible for assisting the board in setting risk strategies, policies, frameworks, and procedures with management and the discharge of its duties. Let me call my colleague to start from there.
Yes, good morning. I'm here to talk about ad hoc committees. So I'll give the introduction and some roles and responsibilities, and then my colleague will continue from there. So ad hoc committees are committees established for a limited time and to address a specific issue or project task. These are temporal in nature and they give specific advice to the board of the directors, all the managers of the company. Once the task is completed, the committee is caused to break up, and they are always established by the board of directors. So here are the roles and responsibilities from the perspective of creditors. The first one is they provide for negative control. The ad hoc committees here provide the creditors with a blocking minority. Yes? Can you hear me?
So
The ad hoc committees here provide the creditors with a blocking minority. It's okay, doctor. If the support of the committee is needed to implement a restructuring. So a blocking minority here, I mean, it doesn't give others to control it, meaning it gives the creditors authority it gives them the authority to control everything, like in the discussion. So the second role is they create a framework for creditors to obtain information. So they provide a best method which creditors would need to obtain information, since debtors and shareholders often find it hard or unsafe to provide sensitive information, thinking the information would maybe become public and negatively impact their business and their business activities. So the third role is they establish an organized process for negotiation. The committees provide an organized procedure for approaching the creditors' discussions. This will help creditors to take control of the restructuring process to ensure efficient operation. This involves planning. Okay, like the negotiation process will involve planning, then defining the ground rules. After that, they justify whether something is wrong or right, and finally solve the problem. Let me leave my colleague Kauthara to continue from there. I'm done with my part. Kauthara, you can continue from there. Good morning.
Please continue.
Yeah, Doctor, I'm done with my part. The other part is supposed to be for Kauthara. I don't know if she's online or.
I also don't know if she's online, so you should send her a message. If not, you continue with the presentation.
Okay, maybe let me continue. So the fourth point is gives creditors a public voice. So here the creditors, they are given, they are given a public voice. They can say anything they want. As they are given a public choice, like a public voice, they express their views, and this becomes so helpful. And it doesn't let the shareholders or the other stakeholders to get engaged. So they put them on pressure. Okay, I can stop there. I didn't revise that. So we can go to the composition of the ad hoc committees. The ad hoc committees have 3 members nominated by Central Review Committee and appointed by the Vice Provost to review the teaching, research, and service performance of a particular candidate according to the guidelines of KPM 210. So one of the members is from the candidate department, and the other members have expertise in candidate fields of research. They are saying this this composition is confidential, but the candidate has the right to refuse certain individuals not to be appointed to the committee, which is accomplished by the way a letter, accomplished by the way of a letter. So ad hoc committees are temporary committees formed by the tackle specific issues of all problems. They are responsible for studying and investigating the issue, making recommendations, and proposing solutions. The composition of the committee includes individuals with necessary expertise and knowledge to address the task at hand. So I think that's all I can say for now. Thanks for listening.
So is group 8 done?
Yeah, we are done.
Yeah.
Okay, group 8, thank you for the presentation. And what you presented is very important because people need to know that committees are formed in such structures where there is mandatory, non-mandatory, and ad hoc committees. So one thing I want you to specify more why it's called a mandatory committee is that they should be there. In most boards, especially of listed companies, those committees must be there. A board without those mandatory committees is not a well-structured board. So you should highlight that in your points. And then for the non-mandatory, you should highlight that you already said they are specific for the company, yes. And it's not that it's a requirement that usually the non-mandatory committees should not exceed 3, because when there are also too many committees in a body, it's too much. And then lastly, with the ad hoc committees, yes, they always react based on the situation. So you should also research more. For example, there might be other types. You can relate it to current situations. For example, during COVID task force, during COVID, I find that the health companies in their boards, they would have committees set up to combat COVID or sort out COVID related issues. So you can also give examples related to the situation. So thank you, group 8. Don't forget to send your slides. And yeah, that's it. So next group, group 9. Group 9.
Yes, group 9, we are ready. So we are going to start.
Yes.
Good morning, everyone. Joanne Merembe. Screen, share your screen. Mercy. Can I continue as Mercy sharing her screen?
Yeah, you continue, but someone should also share the screen.
Okay. Let me be presenting as she's sharing the screen. She's sorting out, I think, some issues. And this is group 9. You're going to present the accounting and financial reporting terminologies. First of all, accounting and financial reporting terminologies, the language used in accounting and financial. According to A.W. Johnson, systematic recording of business transactions in terms of reports, the analysis and interpretation of those reports, and then use those reports for information and guidance of management. I hope you understand. Financial reporting itself is a process of producing financial statements that disclose an organization's financial status to stakeholders, including management, investors, creditors, and regulatory agencies. Financial reports, as you understand, financial reports were cash flow statements, balance sheets, things like that. It is also a process of documenting and communicating financial activities. In accounting and financial reporting terminologies, they have these equity expenses and others. Assets, this refers to things owned by a company and have to be of value now or may have. They can also be tangible or intangible, such as buildings, equipment, cash, cash creditors, etc. Liabilities, this is simply a debt or an obligation that a business always owes to its creditors. Equity refers to the difference between assets and you can money, something like that. Expenses, these are costs that a business incurs in running their operations. You can also talk about profits. Profits are the money that can go. Depreciation. Depreciation, this is the estimated reduction in the value of fixed assets in a given financial year. Accounts payable, this is the money a company's customer owes for goods and services, and they are received but not yet paid for. You have received, refers to physical property. Inventory refers to physical property, merchandise or other sales in terms or other sales items that are held for resale to be sold for future date. Bookkeeping refers to keeping of financial transactions. The accounting records, these refer to documents, books used in the preparation of financial statements. They are reviewed for audits and compliance checks. They may include receipts, checks, sales invoices, bank flow statements. A receipt, this is an official record showing proof of financial transaction or purchase. For example, when you go to the supermarket and you buy some items, you get a receipt. You can keep this receipt for future referral. You can refer to it in the future. For example, when you're making a balance sheet, you go back and see what money you spent while buying those items. You can talk about also ledgers. I used to store entries for a balance sheet and income statement transactions, for example, sales, purchases, and general ledgers. You can also talk about checks. A check is a bill of exchange authorized from a bank. For example, you purchase something and you're paying using a check. someone can write for a check, you take it to the bank and get money. It's like you'll understand this. Okay, with that, I think my colleague can take over. Thank you.
Good morning, everyone. The next part is about principles and practices of financial reporting.
Could you share the screen?
Let's see. Accounting principles are rules and guidelines that companies must follow in financial data, and they ensure that a company's financial statements are complete, consistent, and comparable. These are some of the principles of financial reporting. The first one is going concern. Financial statements are prepared under the assumption that the entity will continue to exist into a foreseeable future. The second is revenue recognition. This principle when to record the transaction, expenses are recognized when costs are incurred, and revenue is recognized when earned. That's the revenue recognition principle. The third principle is the matching principle. The matching principle, income is earned and the related expenses incurred must be accounted for in the same accounting period and financial statements. The fourth is the accrual principle. In the financial period, they occur. For example, for the financial year, our next is the cost principle, where assets and their respective cash amounts at the time the items are recorded as the actual at the actual price as it was sold.
senior management of the company, such as the directors should ensure that the senior management of the company, such as the chief executive officer, that's the CEO, and the chief financial officer, that's the CFO, have adequate knowledge, competency, experience, and integrity to undertake their roles. Also, directors are responsible for financial literacy. Directors should have sufficient and up-to-date knowledge of the accounting principles and practices to perform an of the financial statements. Directors are supposed to seek knowledge from others so that they to date knowledge, so that they understand what the financial statements are all about before presenting them to the shareholder. Let my colleague continue.
Good morning, everyone. Can you hear me? I'm going to take you guys. I'm going to take you guys through the duties and responsibilities, like in the reporting and accounting sector. And I'm going to continue from where my colleague has stopped. And my next point: directors should be competent and adequately resourced in the financial function. Competency
This meeting is being recorded.
Board to know that the board overseeing the company's operations is well qualified and follows all regulations. The board of directors should make short-term plans to ensure sustainability of the company, so that the shareholders are assured that the company is financially strong. And lastly, the annual audit gives shareholders a clear picture of the company's financial status and outlook. That is all for my part.
Good morning, everyone. My name is Asunta, and I'll be taking you through the role of financial statements in corporate governance. I hope you can hear me. My previous colleagues have already told us what financial statements are, but I'll add on by saying they are records that show a company's business activity and financial performance. By that, we mean like they are documents that show what a business is doing and how well it is doing it. And the role of this financial statement, some of the roles are as follows. Financial statements provide a snapshot of a corporation's financial health at a particular point in time, giving insight, its performance, operations, cash flow, and overall conditions. That is to say, they show you how a business is doing at that particular. Can you hear me?
Yes, please, we can hear you.
Okay. I was saying, financial statements provide a snapshot of a corporation's financial health at a particular point in time, giving insights, its performance, operations, cash flows, and overall conditions. They show you how well a company is doing at that particular time, as in it's sort of they paint a picture of how well a business is doing. Then financial statements are important to investors because they can provide enormous information about a company's revenue, expenses, profitability, debt load, and the ability to meet its short-term and long-term financial obligations. That is to say,
This meeting is being recorded.
Want to invest or not. We have some financial. The following that I'm going to say now are some of the financial statements and their roles. I'll start with the balance sheet. The balance sheet shows a company's assets. That's to say what they own, liabilities are what they owe, and the stockholders' equity at a given moment. Then there is the income statement. An income statement reports the revenue generated from sales, the operating expenses involved in creating that revenue, as well as other costs, such as taxes and interest expenses on any debt on the balance sheet. These are the documents that we usually use like regularly in businesses, and they usually help in those ways. My colleague can take you through the other financial statements, and then we'll conclude. Thank you.
Thank you, Asunta. Good morning, everyone. Awar Sharina Linda. I'm going to continue from where my colleague Asunta has stopped. She stopped under the income statement. That is some of the financial statements and their role in corporate governance. I'll kick off with the cash flow. The cash flow statement. This measures the cash generated for a period, including all of the transactions that is added to or subtracted from cash. More still, cash flow is important because it shows how much cash is available to meet short-term obligations, invest in the company, or pay the dividends to shareholders. The next statement would be, that is the financial ratios. Here we look at these financial ratios, therefore, that help investors break down the enormous amount of financial data that are reported by companies. A ratio is merely a metric to help analyze the data and make useful comparisons with other companies and other reporting periods. Under the profitability ratios, here we look at a group of financial metrics that show how well a company generates earnings compared to its associated expenses. We also have other financial statements, that is the return on equity. The return on equity is a common profitability ratio used by many investors. That is to calculate a company's ability to generate income from shareholders, equity, or investment. Operating margin, we have the operating margin evaluates the efficiency of a company's core financial performance. That is, operating income is the revenue generated from a company's core business operations. Most still, we have the liquidity ratios. Here, explaining the liquidity ratios, we look at this. The liquidity ratios help shareholders to determine how well a company handles its cash flow and short-term debt without needing to raise any extra capital from external sources, such as we have a debt offering. Yes, please. Are you getting me? Can I continue, please?
Yes,
we are.
continue.
Okay, thank you. We are looking at the debt ratios. The debt ratios, those indicate another financial statement. We have the debt ratios. The debt ratios indicate a company's debt situation and whether they can manage their outstanding debt as well as the debt servicing costs. For example, the interest, we look at that, such as interest. Debt includes borrowed funds from banks, but also bonds that are issued by the company. Debt to equity ratio, this is another statement, the financial statement. The debt to equity ratios measures how much financial leverage a company has, which is calculated by dividing total liabilities by stockholders' equity. Last but not least, we have the interest coverage ratio. Under this, the interest coverage ratio measures the ease with which a company handles interest on its outstanding debt. The inventory turnover, which you can see on our slides there, the inventory or asset turnover ratio reveals the number of times a company sells and replaces its inventory in a given period. To conclude, that is in the nutshell, the single financial statement is most important since the balance sheet, income statement, and the statement of cash flows all contain crucial pieces of information. I beg to submit, and before I do so, I duly apologize on behalf of our group members for the technical issue we had in terms of our slides. We are truly sorry. Thank you so much. Group 8, Group 9 ends here. Thank you.
Thank you so much.
Thank you, Group 9, for your presentation. The slides were a bit small, but when you share them with me, I'll actually get a full picture. So what I want you mainly to just one, people should mute their microphones. So one point I would like to pull out is that this section of reporting to shareholders, I think it should, I only notice more in published financial statements, but also I think it should also be, what can I say? shed more light on that aspect of accounting regulations. What accounting regulations do shareholders favor more, and what accounting regulations should be instilled? Okay, is there a need for a revision of accounting regulations when it comes to how shareholders should be given accounting information? But apart from that, the content was good. So what you have to do is just send me the slides and I see if I can further rectify it more. So thank you, group 9. Group 10.
That I should call the man.
And if you're not presenting, mute your microphones. So group 10.
Good morning, Doctor.
Good morning.
Yes, group 10 is ready. So let us first screen share.
I'm in a single. Sorry? Yeah, 137. You think there is another?
Yes, good morning, class. So we are Team Costa Rica. So we were handling financial accounting issues and corporate governance. The study of corporate governance is concerned with understanding the mechanisms that have evolved to mitigate incentive problems created by the separation, the management, and financing of business entities. So here in the introduction, understand that financial accounting provides financiers with the primary source of independently verified information about the performance of the company and managers. The economic success of an organization doesn't just depend on efficiency, innovation, and quality management, but it also works with compliance of corporate governance principles. When you set these standards, sometimes you're improving on financial performance of the company and having a positive impact on internal efficiency of the firms. On the other hand, the moment you have improper or ineffective corporate governance, there's lack of transparency, you have poor disclosure practices, and all those things they will reflect in your company. Therefore, you need to have both corporate governance and financial accounting linked. So your central factors of historical costs, reliability, criteria, realizing principles, and conservative principles are you understanding them very well. Therefore, if you don't have a corporate governance perspective, the company is going to be malfunctioning in very many other sectors. So we want to start with creative accounting and corporate governance. Let me leave some of my colleagues to take part as well.
Good morning, members. Hope you're hearing me. I'll give. Hello? Yes, hope you're hearing me, guys. We are seeing creative accounting. It's a method used to make or interpret accounting policies to falsely misuse the accounting techniques and standards being set by the accounting bodies. It's an exploitation of loopholes in the accounting system and audit system after the accounts are finalized. And more so, it's done to manipulate the profit figures in order to eliminate excessive taxation in the future. Often the books of accounts through which these tax figures are found are generally incorrect. The manipulation is done from the very primary level. And main adjustments regarding the accounts, the management wants to manipulate are made by adjusting the figures related to employees' benefits or incentives. Let's go to the next slide. And we are seeing most of the companies or some practice creative accounting to pretend that the condition of their company is sound. Like they want to show that their companies are doing well, in actual sense sometimes when they are not. And we can see the example whereby the company give loans to the unknown person in order to willfully hide the transactions made during the year. They do this to make the government not to put a lot of taxes on their companies in order to make more profits. And more so we are seeing the company raises invoices before the end of the accounting year to inflate its sales figures, but the actual transaction occurs on the post date. More so the other companies increases assets usefully to life. Like they do this in a way, like you buy a car, let's say it will depreciate within 2 years. Then you tell maybe the person who is going to buy, the car will take 5 years to depreciate. In order to get higher depreciation charged. So that's why some companies do so in most cases. I think we shall go to the next slide. We are going to the methods of creative accounting. One of the methods we are seeing is wrong estimation of inventory in stores. On this one, companies practice this method in order to overstate the inventory's value evaluation. And they do this in order to show that their cost of goods sold is understood and thus try to show the increased profit their company will earn this year. And mostly they do this thing in order to attract more investors to their companies. Then another method we can see is failures to make proper contingent liabilities. This one also, it's a contingent liabilities that they are not shown properly in the notes to accounts. Thus, it gives the impression that the company is not having any liability and is free from it. This helps them to reduce on the taxes imposed on them by the government and also get more investors to their company, thinking that the company is doing well, in actual sense when it's not. Then another method is lowering personal liabilities of the company. We are seeing this that the company usually do not tend to show its liability. So it's also a great creative accounting technique which most companies use in order to keep in business. And another slide, we shall go to another slide. And it's a continuation. It's saying they do more in booking less expense. They do this to show lower expenses, whereby the company makes client payments by cash or an outdated check. It helps them to lower expenses per year, and their books of account will depreciate the fewer expenses figure. This may attract some investors. Then another point we are seeing is willfully attempting to manipulate depreciation figure and methods. This is so in many companies use this technique to make good impression on their investors, and the depreciation calculation method is sometimes charged by simply giving a disclaimer. No estimation increase the lifespan of the assets. The management attempts to set an arbitrary lifespan, usually more than expected, so that it can have a less depreciation calculated on the above and corresponding to that increase the salvage of the company's assets. We are seeing that although depreciation is cashless, the calculation of the same greatly impacts the company's finances. The last one I'll give is manipulating revenues and sales figures. This one, companies lower the sales revenue in their books to get rid of taxes, and sometimes they increase the sales figure with some arbitrary transaction to show the company's revenue to encourage their investors. In other words, they do this in order to get more investors to their company so that they can get more money to use. Thanks so much. We'll let my colleague continue from there.
Good morning, class. I'm going to top up onto what Sandra has talked about, and I'm going to talk about financial issues arising in creative accounting and corporate governance. My first point is inaccurate financial forecasts. Here, companies that engage in creative accounting may provide inaccurate financial forecasts that do not reflect the company's true financial performance, therefore misleading investors and stakeholders, thus impacting the company's ability to raise capital or secure new business opportunities. The second financial issue is misleading financial statements. Creative accounting can lead to financial statements that are misleading or inaccurate, resulting in investors and stakeholders making bad decisions based on the false information, which can harm the company's reputation. So here, I think that if you tell the stakeholders that you have a lot of, if your financial statements are showing that you have profits, the stakeholders will base their planning on those fake financial statements, which will mislead them. Then the third point is ethical concerns. This involves deliberately manipulating financial information in order to mislead investors and other stakeholders, leading to reputational risks for the company as well as damage to its relationships with the investors and stakeholders. When a company fakes its financial statements, and maybe people get to find out the company's reputation, if it is a big brand, its reputation will be distorted, like people won't trust it again in its operations, and it will lead maybe to some companies may collapse because of that. The fourth point is legal and regulatory risks. Companies that engage in creative accounting practices may be at risk of regulatory penalties, fines, or lawsuits, which harm the company's reputation and financial performance, impacting the ability to attract new investors and customers. Yeah, let's go to the next slide. Yeah, then the other issue is poor corporate governance. Companies without effective corporate governance structures are more likely to engage in creative accounting practices, leading to damage of company brand and relationships with the stakeholders. The other point is conflicts of interest, which arise when corporate insiders have a financial stake in the company's performance. This creates pressure to engage in creative accounting practices, making the company appear more profitable or financially stable. Of course, if you show the public that you're getting profits, that's what they will know, except maybe those guys who are inside and they're involved in those issues. Then the other point is revenue recognition. Creative accounting involves recognizing revenue prematurely, inflating the amount of revenue or delaying the recognition of revenue to future periods, creating a false picture of the company's financial performance, thus inaccurate valuations. The other point is expense management. Creative accounting can involve understanding expenses to make a company's underestimating expenses to make a company's financial performance look better than it is. For example, delaying recognition of expenses, misclassifying expenses, and manipulating depreciation schedules. Yes, so now I'm going to look at the role of corporate governance in detecting creative accounting issues. How corporate governance is used to, like, maybe try to stop those accounting practices. The company needs effective corporate governance to reduce the likelihood of creative accounting and, in particular, fraud. This involves effective internal controls and effective independent scrutiny of the executive directors by non-executives. In particular, there are perhaps 4 main areas in which a company ought to pay attention to detect creative accounting issues, and these include corporate governance can be used to detect accounting practices through effective internal controls. These include a control environment, risk assessment and management, monitoring and control activities. If a company has strong controls, it will inhibit the possibility of financial malpractice. The collection of controls provide a key mechanism combined with internal audit whereby malpractice can be minimized. And then another way is through division of responsibility between the chief executive and the chairman. If one person is both the chairman and executive, it's particularly dangerous. This is an essential division of authority in the boardroom, which prevents unmitigated exercise of power by one person. Here, I think they mean that all the responsibilities shouldn't be left to one person. There should be transparency. The next part is audit committee. The audit committee is a relatively new development. It is responsible for supervising the auditors. This is important that the audit committee to be effective, and it should be independent, specifically not staffed by friends, acquaintances, or family members of the executive directors. It also needs to meet frequently and is staffed by experienced individuals. The last point in this part is independent board of directors. The board of directors itself should be strong and effective. And in order to achieve this, it should be independent. There should be independent non-executive directors. I think that's it. Other members can continue from there.
Hello, good morning. Hope you guys are listening. My name is Maxensha, and I'm going to talk about earnings management, home management, and corporate governance. First of all, earnings management is the use of accounting techniques to produce financial statements that present an overly positive picture of a company's business activities. Earnings management was strategy used by the management of the company to intelligently manipulate the company's earnings so that the figures match the predicted targets. And another thing, excessive earnings management can lead a company misrepresent facts on its financial statements which can cause the Securities and Exchange Commission to impose fines and punishments. And the businesses that use earnings management to meet the financial goals. The businesses use earnings management to meet financial goals and investor expectations, because most of the businesses always have the investors, and those investors always have their targets that they think that they are going to get from those companies. So in order for those companies to meet the investors' targets, they have to use those the earnings management or manipulation so that they can meet their investors' targets in order to look good, maybe for any funds, for any other capital, so that they can be given, not to lose out on any funding. And we say that that corporate governance is the way how the company can be managed or controlled. That is in simple terms. I think, okay, you can go to the next slide. Here we have the issues relating to earnings management or manipulation and corporate governance. First, we have expense manipulation. This financial issue involves companies manipulating earnings. For example, they may overstate expense to create reserves that can be released in future periods, or underestimate expenses to increase product. Therefore, this issue highlights the importance of transparent and consistent accounting policies. That's an issue in here. Okay, like expense manipulation. For example, maybe for example, the company can overset expenses to create reserves. I hear a company, maybe for example, if it is selling products, it can say we have sold this product at this amount, yet in actual sense it is not the amount. So that maybe, for example, if the investors are checking in the books of accounts, they can see that that company is doing well, yet in actual sense it's not. Another thing is revenue recognition. Here, companies may recognize revenue before it is earned, or delay recognizing revenue until a later period to meet earnings targets. Through generally accepted accounting principles for recognition, hence a financial issue in earnings management or manipulation and accounting and corporate governance, revenue recognition. For example, here maybe if a company is selling products, for example, Mukwano is selling, for example, soap, it can estimate and be like in the accounts, in the books of accounts, it says we have already sold, for example, like 100 boxes of soap. Yet in actual sense, it has not yet sold them, and it makes that account go in the books, so that maybe the investors, in case they are checking, they can say, meaning Mukwano is working well, we can invest in it. Yet in actual sense, it's not. Then asset valuation. Companies may manipulate the valuation of assets by overvaluing liabilities or misrepresenting the useful life of assets, hence a financial issue. Here, for example, if the company is selling cars, for example, Toyota, it is selling cars. So it will say, for example, if someone comes to buy a car, it will say the depreciation period for this car is maybe 7 years. It's 7 years. Yet in actual sense, for them, they already know that its depreciation is going to, the person is going to use it for 4 years, and it depreciates. But then to show that the company is working very well, it will say that this car will be used for 7 years. After 7 years, it will depreciate. Yet in actual sense, the car is going to work for 4 years. Okay, some other slide. We have related party transactions. These are transactions that occur when a company does business with a related party, such as subsidiary, affiliate, or director. Therefore, these transactions can be used to manipulate earnings by I think I can go.
Yes, Con.
And you do not need to read everything, just highlight.
The board of directors okay, board composition. This is always done by the directors because they always want to benefit from it. So by doing this, the moment the board lacks independence, this results into weak oversight and an increased risk in financial statement manipulation. We also have executive compensation. Here it comes in where, for example, the company will seem as if it compensates its employees so that maybe it can create a good image for itself, yet in actual sense the employees are not getting compensated as the way they expected to. Okay. Another one, the internal controls. These internal controls, the moment they are weak, it can make it easier for the management to manipulate the financial statements. Therefore, it has to be strong so that it can be productive, hence the financial issue. And lastly, what I can talk about is incentive structures. The executive compensation structures that prioritize short-term earnings manipulation, and thus a financial issue in earnings management and corporate governance. I think, okay, we can go to frauds. Thank you.
Could you continue in class? This is Joanne.
Joan, please come present your part. While she comes, I can continue. Fraud refers to deliberate international. Fraud refers to deliberate and intentional deception by a company.
Actions committed either by a company or individual acting in their capacity as the employee of the company. Yeah. So I want to first highlight some of the reasons why companies carry out corporate fraud. Hello, class?
We are hearing.
Continue. Yes, these are some of the reasons why companies engage in corporate fraud. One, the desire or perceived need to attract and retain investors. Here many companies carry out fraud schemes. Here many company fraud schemes consist of fraud accounting schemes used to make a company appear more profitable than it actually is. So these people want to try out all the illegal things they can do to make sure that they are at par, which is not always good. The impetus behind such a scheme is the desire or need to attract and retain investors. Then the second one could be the defects with a company products, problems or defects with a company products, which it tries to hide may lead into fraud. Yeah, several recent corporate fraud cases have occurred with pharmaceutical companies that attempted to hide certain side effects or dangers of using some of their products. Yes, Cookie. Move to the next slide. Hello? People, my network is poor. Cookie.
Move to the next slide.
So I'm going to also highlight about various financial issues arising in fraud and corporate governance. One, we have accounting irregularities. Yeah. Fraudulent companies may engage in accounting irregularities such as improperly recording revenue, recording financial transactions, creating false documents, or inflating the value of assets. This can lead to inaccurate financial reporting and mislead investors, creditors, and regulators. Then the next one is mispresentation of financial statements. Fraudulent companies often misrepresent their financial statements like their financial positions. This can be done by manipulating revenue, expenses, assets, liabilities, and equity. Therefore, financial statements may be financial position and appear stronger than it actually is. Yeah, the next one is material omissions that involve intentional omission of important financial information in order to mislead investors or other stakeholders. Therefore, this can include failing to disclose material risks, liabilities, or related party transactions. Cookie. Cookie.
You have less than 10 minutes remaining.
Yeah, the next ones are financial transactions, improper revenue recognition, lack of internal controls. Let my next person add on. Let the next member add on for the interest of time.
The other points are overstated inventory, of balance sheet financing, lack of transparency, bribery and corruption, whistleblower retaliation. For this point, this issue occurs when a company punishes or discriminates against employees who report suspected fraud or other wrongdoings, therefore discouraging employees from reporting fraud and can lead to further ethics lapses in the company. Here, it means like you can realize your manager is like playing around with some figures. So you approach maybe the senior of your senior to tell him that some figures are being messed with, and they punish you for it. It can be a punishment through like maybe if the appraisal raises, they appraise you for not having teamwork, for not supporting your team, for not backing up your friends. They can cut your salary. They put very discouraging measures. Next time you see an error, you don't bring it up. The last point is insider training. Yeah. Moving on to role of corporate governance in preventing fraud in companies. Corporate governance ensures compliance with government rules and regulations. There is management overview of risks, because now they're like managers can see where the manipulation of like figures, if some information is wrong, so on. Good governance will detect fraud and corruption. Next point is ensuring transparency and accountability. It defines span of control, as we have been mentioning. that it's good to have independent board members separate from executive committees and other stakeholders. Lastly, it encourages fairness. Let's the rest of my group members finish up with internal and external audit influence in Uganda. Yes.
Hello.
You may
Please
continue.
continue. We are running out of time.
Am I being got right? Hello, class.
Yes, we can hear you.
So due to my friend Shadi is not around, I'm going to talk about the internal and external audit influence in Uganda. Internal audit refers to the process of evaluating an organization's internal controls, risk management processes, and overall operations. It helps to identify weaknesses and improve organization's efficiency, effectiveness, and compliance with the laws and regulations. Internal audit is mandatory for all companies in Uganda. Then to the external part of it, external audit is an independent examination of an organization's financial statements by an external auditor. Its primary goals is to provide an opinion on fairness and accuracy of the company's accuracy of financial statements, as with the relevant account side, please. Cookie, next slide about the issues rising. Issues arising internal and external audit influence on corporate governance in Uganda. Number one, compliance with laws and regulations. Point number one, financial accounting issues can also impact compliance with laws and regulations, including tax laws, accounting standards, security regulations, and others. None of the compliance can result into fines, legal action, and reputational security regulations. Non-compliance can result into damage, can erode trust in companies and management. Therefore, the internal and external audit can help to identify areas where compliance may be lacking and provide recommendations for corrective action, which can improve corporate governance, ensuring the company is operating within the law and fulfilling obligation standards. Then point two, fraud and financial misreporting. One of the primary concerns in financial accounting is the risk of fraud and financial misreporting. Therefore, financial statements are inaccurate, or incomplete, which can lead to incorrect conclusions about the financial health of the company, which can undermine the trustworthy investors, regulators, and other stakeholders. Next part, please. The third point, information quality and reliability. The financial accounting issue can also affect investment decisions. If informing is inaccurate or incomplete, this can lead to incorrect conclusions about the financial health of the company. The next point is transparency and accountability. If financial information is transparent or lacks accountability for financial decisions, which allows the company and management, therefore internal and external audits can help to improve transparency and accountability by providing independent assessments of financial information and highlighting areas of improvement. The last part of it, I beg like Cookie to give the conclusion because it wasn't in my parts.
Yes, in conclusion, in order for companies to overcome the various financial accounting issues in creative accounting and corporate governance, they should implement strong corporate governance practices like independent auditors, a board of directors that is actively engaged in financial oversight, and transparent financial reporting. For issues in earnings management or manipulation and corporate governance, regulators and standard setting bodies have implemented various regulations and guidelines such as the GAP, the Generally Accepted Accounting Principles, and the International Financial Reporting Standards. Concerning financial accounting issues in fraud and corporate governance, companies need to have strong internal controls, independent oversight by boards of directors and external auditors with transparent financial reporting. So the last conclusion is in internal and external audit influence and corporate governance in Uganda, companies ought to have effective corporate governance to manage internal audit and ensure external examinations in the company's financial books of account are portraying transparency and true accountability. Yes, thank you very much. That's all from Team Costa Rica.
Thank you, Group 10. One thing I should point out, when you're presenting, you don't have to read everything. When you read, it seems like someone made the notes and you're just reading them out. So you should summarize for those who are also listening to understand what you're saying. So you don't need to read the whole paragraph every time. So because that takes some time, and you'll also not explain, some of them needed a simpler explanation. So, but apart from that, the content, I like the content. And also one thing I'd like you to explain further is that what differentiates creative accounting from the rest is that creative accounting is not illegal, while earnings management and fraud are illegal aspects. And creative accounting leads to earnings management and fraud. So you should also highlight that how creative accounting happens, but it's not an illegal form because it's not too extreme. It might be illegal, but it's unethical. So I'd like you to also have a section whereby you actually relate those three. And yeah, and that's it. So group, what is it, international business, you may start. Thank you, group 10.
No.
If you're done with presentation, mute your mics.
Good morning, class. I'm presenting the first part for international business that is talking about the organization for economic cooperation and development.
There is an echo behind, so could you remove that echo? It's echoing. So your neighbor should mute or something, but it will be hard to listen to. It's not an issue with your Zoom. It's that you're next to someone who is who is also listening to a device, so it creates an echo. So let that person next to you mute, and then you can speak. Group 1, you should start. If group 1 is not ready, group 2 can present.
Sure.
Sorry for the network, it was a network issue, but I'm presenting the principles of OECD that were revised in 2004. And the first principle is that to ensure that basis of an effective corporate governance framework, whereby they had to ensure transparency, articulating the division of responsibilities among different supervisory, regulatory, and enforcement authorities. Then the second principle is the rights and equitable treatment of shareholders and key ownership function. With this, they had to protect and facilitate the exercise of shareholders' rights, ensuring equitable treatment of all shareholders, including the minority and foreign shareholders. Then the third principle is the institutional investors, stock markets, and other intermediaries. By this, they had to provide sound incentives throughout the investment chain and provide for stock markets to function in a way that contributes to good corporate governance. The fourth principle is the role of stakeholder in corporate governance, whereby the stakeholders had to, the shareholders had to recognize the rights of the stakeholders established by the law through the agreements and encourage active cooperation between the corporations and the stakeholders. Then disclosure and transparency. They had to ensure that their timely and accurate disclosure of all the material matters regarding the corporation, the financial situation, performance, ownership, and the governance of the company to both the stakeholders and the shareholders. Then the responsibilities of the board. They had to ensure the strategic guidance of the company, effective monitoring of management by the board, and the board's accountability to the company of shareholders. We are sorry about the sharing of the screen, it's network error, but I'm done with my part for principles. My colleague is going to take on. Thank you.
Thank you. Thank you, Rachel. Yeah, Mia, technology. Okay, I'll add on. My question is talking about how the revision of the principle was carried out. So I'll be taking you through how the review of the principle of OECD, that's Organization of Economic Cooperation and Development, revised. The revision of OECD principles of corporate governance, they revised it on April 2nd, 2024. It included a number of proposals and as well as new changes took place in existence. The members who were there, they were representatives of the OECD, the 4 members of OECD, and the non-members of OECD. The best reason for calling this, it was the serious scandal that had undermined the confidence and integrity of corporate finance and institutions of the market. The assessment was carried out under the responsibility of OECD Steering Group on corporate governance, with the activities participants basing on the key institutions. The institution included the Bank of International Settlement, the IMF, World Bank, and so many institutes. Even the leading businesses, the labor representative also participated. Sorry for that, we are trying to share the screen, sorry. The steering of groupment questionnaires, questionnaires were distributed to member countries, informing them about the corporate governance issues, and a proposal calling in Jan 2024, a draft was revealed, posted and on an internet, and comments were got generally. Some 75 submissions were received. Private individuals, professionals, associations also they were involved in a debate of a new review of the OECD principles on website for the public access. In our slides, it's more detailed, the process is more detailed, but I've tried to summarize for you the basis of the review. The basis was just to call for the serious that had been undermined the confidence in the integrity of corporate finance institutions and markets. Yeah, that's for my part. As you see here, the OEC ministers in 2022 called for it, but it was implemented in 2024. Yeah, that is it. Let me call my friend, because of time I have to be time managers. Let me call my friend Mina to add on from where I've stopped.
Good morning.
Good morning.
I am going to be presenting reasons for the review of OECD principles. Number one, to ensure the basis for an effective corporate governance framework. And then it was reviewed to protect rights of shareholders and key ownership functions. And it was also reviewed to ensure equitable treatment of shareholders. all shareholders should have the opportunity to obtain effective redress for violation of their rights. And then also, it was reviewed to update the principles in light of recent evolution on capital markets, its governance policies and practices. Then lastly, it was reviewed to support corporate sector resilience and to improve companies' access to finance from capital markets. Yeah, that's it. I'm going to invite the next presenter. The next presenter, you can kindly take over. Hello.
Hi everyone. I'm going to take you through part B of question 3 for international business. As a Ugandan, do you agree or not on its successful acceptance and implementation in Uganda's firms and why? I mean the OECD. For me, I do agree with that. The question is two-sided. So we shall have the positive side and the negative side. So there have been some success stories of the Uganda firms adopting good governance practices in the line with the OECD principles. For instance, the Uganda Securities Exchange has implemented corporate governance standards based on the principles of some companies voluntarily adopted and voluntarily adopted them. You shall see some of the success of the OECD in Uganda. Are you hearing me?
Yes, please go ahead.
The first one is Uganda is a member of the OECD Global Forum of Transparency and Exchange of the Information for tax purposes, which could indicate a commitment and implementing good governance practices. The other success is that because Uganda as a government has passed laws and regulations to promote the transparency and accountability in the corporate sector. There's also growing interest in social responsibilities and sustainable business practices in Uganda, which aligns with some of the OECD principles. Some Ugandan firms may see the adaptation of good governance
that I'm seeing you.
I think for the interest of time, there were 15 points. My colleague will start from here as we had all agreed. We all have to say something, and then we shall give the detailed write-up to the class group. Thank you.
That's why the Wi-Fi doesn't play me again. Because after these guys, I have to start. My part is small. Have I muted?
On every
Yes, so group 1. I don't know what the background noise is, but group 1, international business, Thanks for the presentation.
Good morning, guys.
I'm still speaking. Group 1 International Business, thanks for the presentation. What I would like you to do is that, no, you've explained everything, but for the last part, when you're explaining the pros and cons, and you give your final conclusion on its implementation in Ugandan farms and why, I hope that when you're giving them, you're actually relating them to corporate governance, its relationship to the development of corporate governance in Uganda. So you should actually push that out more, because this is corporate governance and you're trying to actually explain its relationship with corporate governance. Then group 2, you may start. The rest of you should mute your microphones. If you're not speaking, mute your microphone. So I don't know who is supposed to be. I can't know who is who from these names on the side. So mute your microphones if you're not speaking.
Doctor, can you see the slides?
Yes, I can see the slide.
Good morning.
Good morning.
Yes, my name is Maggie, and I'm starting from question 2, group 2. Okay. We are going to talk about the companies listed, and we chose Umeme. So let me give a brief about it. Uganda currently has 10 public listed companies governed by rules and regulations on capital and Chair, please. The person sharing slides. Okay, public listed companies. These are companies which have their shares. Oh my God, the person sharing. Chair, please, let's start from the first slide.
Okay.
Yeah. The next one, please. Okay. So Uganda currently has 17 public listed companies governed by rules and Chair, can you please take back to the first slide? Okay, thank you. That one, okay. Public listed companies, these are companies which have their shares listed on any of the stock exchanges, which allow the trading of their shares to the common public. This is to say, anyone can sell or purchase the shares of those companies from the open market. Next slide, please. So we have examples of those companies that are listed, and below there is Uganda Clays, British American Tobacco, Uganda Limited, listed on October 2000, Bank of Baroda, Stanbic Bank. Let's continue, Chair. Next slide, please. Oh, let me continue. Share on the slides. Okay. We also have Umeme. We have Sorry, I'm having network problems, and Chair, you're not in line with me, but okay, let's continue. We have Umeme Limited, MTN Uganda, New Vision, and National Insurance. So, Madam, we chose to work with Umeme and to look at its corporate governance. Corporate governance of Umeme Limited. Corporate governance, it's a system of rules and processes by which a company is directed and controlled. Corporate governance is the system by which companies are directed and controlled. It identifies who has power and accountability and who makes decisions. So we look at the government structure in Umeme. And first of all, to explain government structure, it refers to the framework of project management, especially regarding roles, procedures, and roles and division of responsibilities within the whole decision-making process. The governance structure keeps the project in check, allowing it to run flawlessly and in accordance with the plan. Governance frameworks are the structure of government and reflect interrelated relationships, factors, and other influences upon institution. Governance structure is often used interchangeably with governance framework, as they both refer to the structure of the governance of the organization. Now, talk about Umeme Limited. It is the largest energy distributor in Uganda, distributing about 97% of all electricity used in the country. The shares of the stocks of the company are listed on the Uganda Securities Exchange, that is USE, and are cross-listed on the Nairobi Stock Exchange, NSE, and regulated by the Electricity Regulatory Authority. It was founded in 2004. Its headquarters is in Rwenzori House, Kampala, Uganda, and its enrollment is 1562 for 2021. Before I talk about the board of directors, I want to say Umeme is governed by 10-person board of directors, and they're elected at the 9th annual general meeting. So if I talk about the board of directors is responsible for settling the company's strategy, overseeing its operations, and protecting the interest of shareholders. The board should be independent and comprise a mix of executive and non-executive directors. Then we also have the shareholders. Shareholders have the power to elect the board of directors and approve major decisions, such as mergers and acquisitions. They should have access to accurate and timely information about the company and should be able to exercise their rights in fair, transparent manner. Then the management team is responsible for implementing the company's strategy and ensuring its day-to-day operations run smoothly. They should act in the best interest of the company and its stakeholders and be accountable to the board of directors. I'll let my colleague take on the next part.
Morning. Hello, morning. Good morning, members. Hello.
Good morning. You may continue.
Okay, so I'm presenting the principles of corporate governance. Below the principles of corporate governance, I tried to connect them with a corporate governance structure, but I needed some guidance, doctor, and that's what I managed to come up with. So the corporate governance structure has the shareholders, the board of directors, the officers, and the employees. So these are the principles I hope they are supposed to follow while carrying out the corporate governance. So there is fairness, transparency, risk management, responsibility, and accountability. The notes are more detailed, doctor, and we are going to share them. So I hope my colleague can start up from there. Okay, fam, to continue, I hope my colleague is not coming. I think my colleague is not coming, but maybe.
Okay, talk about OECD principles of umeme that which you can share the slides. You can go direct principles. The key principles of OECD. One is ensuring the basis of an effective corporate governance framework. Another one is the right and equitable treatment of shareholders and key ownership function. So here umeme has to keep on like fair treatment of the shareholders, which include the customers, government, suppliers, financing agencies, partners, stakeholders, among others. So maybe as an organization, it has to treat them equally. Here you may even talk about the basic shareholder rights that should be included. So here some of the rights of shareholders include they have transfer share, obtain relevant and material information on corporate on a timely and regular basis. The shareholders have to participate and vote in general shareholders meeting. Shareholders, they also have a right to elect and remove members of the board. Another one, the shareholders have a right share in the profits of the corporation. See, to continue on the principles, we have the institution, investors, stock markets, and other intermediaries. Another one is the role of stakeholders in the corporate governance. So in this case, the corporate governance framework should recognize the rights of stakeholders established by the law or through mutual agreements and encourage active cooperation between corporations and stakeholders, creating wealth, jobs, and sustainability of financially sound enterprise. Another principle is the disclosure and transparency. As you see, women as an organization of a corporation, it has the value to maintain or continued disclosure of relevant, timely, and information to shareholders. So it has to disclose everything, every information that is needed to be known to this. Another one is the responsibilities of the board. The board of directors of Meme Limited understand and appreciate that sound governance practice involving the OECD principles. Since those principles are worldwide accepted and considered as the standard, that's what I can present. I think the next presenter can take over.
Lucy, where are you? Hello, Lucy. You are the next one to present.
Lucy is having some network thing. I've explained all the parts, but I'm going to present principles of David. So unique reason of
Okay, let me continue. I'm going to present the diversity principles. Diversity in corporate governance means about creating an inclusive environment, accepting of every individual's differences, enabling all employees to achieve their full potential, and as a result, allowing the business to reach its fullest potential. Diversity should be part of a cooperative and functional board of directors, shareholders, and management team of the company, which are able to respond to the requirements set out in the company's business and strategic objectives. Significant diversity factors concerning the composition of the corporate governance framework include mutually complementary variety of competencies, education and experience backgrounds in different professional management and industrial field. Hello everyone, are you hearing me?
Yes, we can hear you.
Okay. So the factors I've mentioned becomes the key of diversity. So I will present the corporate governance of Umeme Limited by highlighting diversity principles. There are principles like race and ethnicity, age and gender identity, sexual orientation, religious, spiritual beliefs, disability, and socio-economic status and background. Start with race and ethnicity. Corporate governance, there is no discrimination by race and ethnicity. People who belong to diverse racial and ethnic groups bring in unique perspectives. Women's corporate governance ensures this principle by improving and different cultural norms. The next principle is age and good corporate governance should ensure employment of who are in different age group and in different generation because it brings this to the company. Some of employees are young but educated in universities, while others are old but have bound experience based on their age. So age distinguishes the people from generation X to Z, and Umeme employs the people in different generations distinguished by their age. Next one is gender and gender identity. Since half of the country's population consists of women, it is becoming critical to have equal representation for them in the workplace. This principle does not mean the number of women and men in the company, but equality. Umeme observes this principle in certain level by addressing the issues like gender pay gap, where women are routinely paid less for the same jobs, since this is the widely considered as an essential part of corporate governance. The next principle is sexual orientation. This is about who a person is attracted to. This is a personal affair, yet employees must feel safe to express their sexuality with their colleagues without facing any discrimination or workplace harassment. So good corporate governance ensures safety for people belonging to sexual minorities. The next one is religious and spiritual beliefs. To promote diversity in workplace, it is vital to be aware of companies' unconscious biases regarding to religion. Freedom to follow own religious practices like celebrating Ramadan or hijab or wearing hijab depicts tolerance and equality in the workplace. Umeme observes this principle by providing the designated prayer rooms, religious holidays, and celebrations so that it can create a diverse work culture and good corporate governance. The next one is disability. Disability is not only meaning the situation associated with the physical mobility, but limitations in vision and movement to running abilities and mental health issues. Since Umeme is the electricity company, there are a series of accidents among the employees while performing the tasks assigned by the company. And some of employees become disabled and provides strict safety standards and health compensation. The last principle of diversity principles is socio-economic status and backgrounds. All employees from the top level managers to the lowest level employees, even shareholders, have the different backgrounds in the various factors like education, social status, race, etc. Corporate governance framework should ensure no employee is judged for their social status and must hire people from all backgrounds. Umeme ensures this principle by employing the people with different backgrounds, like some from poor family, while others are from wealthy family, or some with a high educational level backgrounds, while others with low educational level background. For example, an employee who graduated university and got the degree of master's, while another employee who graduated high school. This is all diversity principles. The details are mentioned in the write-up. I will share the write-up after the presentation. Then there are certain benefits by observing diversity principles. You can read the benefits in the slides. In conclusion, it is very important to understand the importances of diversity in corporate governance for every organization. But here, there are two important things to note. The one is every company has its own unique sets of circumstances and challenges. So it is up to the stakeholders of the company to determine the level of diversity. And another factor which is important to note is that following diversity principles is not mandatory for every company. This is all I present. The next part, the suggestions to shareholders and executives for successful governance structure with limited risks, will be presented by another member. Thank you.
Good morning, everyone. My name is Sanyo. I'll be presenting the solutions to establish a successful governance structure with limited risk. As my colleagues explained, corporate governance is a system of rules, practices, and processes by which a company is directed and controlled. So in order to achieve this, there are various steps that a company is supposed to take, and that's what I'll explain. One is develop clear policies and procedures. So for this, for a company to succeed in corporate governance, when you develop clear policies and procedures, this helps to ensure consistency and transparency in governance policies. Because without transparency in anything, governing a company will be very hard. Then the next one will be appoint independent directors. These directors should be without conflict of interest. We all did company law. We know what conflict of interest means. If you have conflict of interest, you cannot suggest well, you cannot come up with very straight decisions because you don't know what to do. So this can help to mitigate risks associated with conflicts of interest and improve the quality of decision making. The other one is promote accountability and transparency. That is a bit self-explanatory, but with accountability and transparency, it can be achieved by establishing a clear code of conduct, providing regular updates on performance and risks, and ensuring that all stakeholders have access to relevant information. You know, stakeholders are the employees, us, the customers. So you should ensure that you have relevant information. The other one will be foster a diverse and inclusive environment. You should try to, a diverse environment is where, like, you have different managers from different parts of the world or from different places, because As we all know, different people have different, let me say, they manage things differently and they think of things differently. So when you have a diverse environment, you can come up with very clear rules on how to manage your company. 5 is implement effective risk management practices. Risk is a very big, every business is faced with risks. So implementing effective risk management practices will help the business keep moving so that you keep governing an enterprise. You cannot govern anything without it being in existence. We have continuously evaluate governance practices. If you evaluate practices, you can understand, you can know where you went wrong, what you did wrong, and what you can implement to change everything, and the company will keep moving. The other one is establish a code of ethics and conduct. A code of ethics, let's say they can be rules, a code of ethics and conduct. Most companies have this. They can be rules that a company follows according to certain practices. Let me say hiring employees or cutting off some employees. Then lastly is establish clear roles and responsibilities. This helps managers to not collide when making decisions, and employees know to whom to report to on what situation. My colleague will start from there, Charity. Thank you so much for listening.
Yes, good morning. I'm going to continue from what Tanya has talked. Engage with stakeholders. Here it means we have to involve stakeholders in decisions that the company is making, so that we don't have independent decisions, so that we involve them, and then we know their suggestions as well for the betterment of the company. And then leadership and strategic direction. Here we should have clear leadership, as in who should be next in line after this director is gone, after this CEO is gone, after all that is done. Then we should have effective external relationship. External relationship in this may be with our stakeholders, and basically it's with the stakeholders, which means the government, the clients, and so forth. Then challenge on delivery of agreed outcomes. In this case, we should challenge on delivery of agreed outcomes. How to overcome the challenges that may come up with corporate governance. Hello. Hello. Then aim for long-term value creation. In this case, the suggestion should be for the directors to aim for longer term instead of looking at only the short-term goals of the company. Then balance board composition should not be composed of only, let's say, the males or the females only. It should have balance. Even those that are disabled, let's say they are lame, as long as they can contribute positively to the company, they should also be considered. Then evaluate the board regularly. This means we should evaluate the board regularly. This means we should always look at what the board does,
let's not look at what the board does. Basically that. Let my other colleagues continue.
Charity, you are the last one.
Yes, in conclusion, by implementing these suggestions, shareholders and executives can establish a successful governance structure with limited risk. This can help to improve the organization reputation, increase stakeholders' confidence, and drive long-term value for all stakeholders. That was the presentation. Thank you very much.
Okay, thank you, Group 2. That was a good presentation. So, your first presenter needed clarification on part A. So what I wanted is for you to describe the governance of Umeme, looking at their board, shareholders, management, and then relate to if they follow the principles of transparency and so on and so forth. If you find the board and their shareholders and management actually following that, they are following the OECD principles, and whether they follow the diversity principles, which I think you covered. So that was it mainly. You just had to show the relationship between their governance structure and whether that structure of theirs abides by such principles. And then also part B, you are like, okay, sorry, when it came to suggestions, one suggestion also I think you should include for shareholders, especially for shareholders. Most times shareholders are seen as a silent party. So you should also include that suggestion specifically for shareholders, and maybe you should also separate shareholders from executives, what suggestions they should be, so that it's more detailed. When they are merged, some things might be hidden. For example, shareholders sometimes it's suggested that shareholders should have an active role whereby they are not only silent, but they have some hands-on input and not only just wait for an annual general meeting and make decisions, but they should also have an active role. So I think it's better you separate those suggestions. However, the points were good. So thank you, Group 2. That was a good presentation. And kindly send your slides, all of you should send your slides. And then also the Word document should be hard copies. I do not want soft copies of the Word document. So the Word document should be in hard copies. So thank you. If you have any questions, you can ask me.
We have a question here.
Yes.
The relation of corporate governance of Umeme Limited to corporate governance principles. We have tried to relate the principles to Umeme Limited, but we have failed to relate that one.
No, what I wanted, you know what the principles are. There is independence, transparency. Now, for example, if the board, or if Umeme has a board and they are non-executive directors and independent directors, that shows there is independence. You get what I'm saying? So yes. You relate and you just look at the structure. Responsibility. Does it show there's responsibility because there's a structure whereby there is the shareholders, management, and board of directors? Responsibility meaning that they are not sharing the same roles. There is no conflict of interest. There is separation of ownership and control. So you just look at the structure and how it's organized and you try and see whether it's related. I hope you've gotten that.
Thank you, I've gotten that.
Okay. So if you don't have any questions, I wish you a lovely Saturday, and And if you have any others, you can send me a WhatsApp or an email. So thank you and have a good day.
Thank you.
Thank you.
Nice.
You too. Bye.
Bye, doctor.
Bye, doctor. Thank you so much.
You're welcome. Thank you too.
You're welcome.
The recording has stopped.
So the Zoom meeting is done. That's the recording. So if you know that there is a member that will not attend, you give them the link of this video, let them watch. Now, it's their time. The YouTube video will be here for long. It will not be deleted. So share it with your friends so that you can all benefit from this stuff. Thank you.